Let's talk about your credit score. You know, that three-digit number that kind of holds a ton of power over your financial life? But what if you could not just understand it, but actually, control it? Well, that's what we're going to do. We are going to crack the code on that number and turn it into one of your most powerful tools. Okay, let's get into it.
Just think about that for a second. A 50-point jump right when it matters most. For a mortgage, that kind of difference can literally mean saving tens of thousands of dollars over the life of the loan. For a car, it could be the difference between getting that sweet approval or getting denied flat out. It really is a total game changer.
So the big question is, how do you get a boost like that, especially when the clock is ticking? It sounds a little like a magic trick, I know, but I promise you, it's not. It's a very specific strategy, and by the time we're done here, you're going to know exactly how it works and how to use it yourself.
But listen, before we get to the advanced plays, we have to nail the fundamentals. Your score is really just a summary, kind of like a grade on a much more detailed document, your credit report. So if you want to influence the score, you first have to understand the report that it's built on.
A credit report is basically your financial resume. There are these for-profit companies called credit bureaus. You've probably heard of the big three: Experian, Equifax, and TransUnion. They collect all this information from your lenders and public records, and then they sell that report to other lenders who use it to make a super quick decision about whether or not you're a good risk.
So what's actually in this thing? It's usually broken down into four main parts. You've got your basic identifying information, name, address. Then there's public records for things like bankruptcies. Then you have the big one, your credit information, which details all your accounts. And finally, a list of inquiries, which shows who's been peeking at your file recently.
And what's not on your report is just as important to know. By law, it can't include really sensitive personal stuff like your race, religion, or medical history. And here's something that surprises a lot of people. It doesn't show your checking or savings account balances. It is strictly about how you've handled debt, period.
Okay, so that's the report. Now, how does all that data get crunched down into that single, super important three-digit number? Well, that's where the scoring models, like the famous FICO score, come in. They take all that info and group it into 5 key categories.
Now here's the absolute key thing to understand. Scoring models don't treat all your data equally, not even close. They weigh different parts of your report way more heavily than others. In fact, just 2 factors are responsible for the vast majority of your score. Seriously.
Just look at this breakdown. Payment history, which is simply, do you pay your bills on time? That's a massive 35% of your score. And right behind it is the amount owed, which is also called credit utilization. That's another 30%. Add them up, that's 65% of your entire score right there in just 2 things. The takeaway is simple. If you want to make a big impact fast, those are the 2 areas you got to focus on. All right, let's shift gears and get practical. Let's see how all this turns into daily habits. Because understanding the what is one thing, but knowing the how is what really builds a great score over the long haul. And we've got to separate the facts from some really common myths that can actually hurt your progress.
Oh man, this is probably the most common and costly myth out there. This idea that you have to carry a balance and pay interest to build credit. It's just plain wrong. You do not need to do that. Paying your statement balance in full every single month still reports a perfect on-time payment, and it saves you money. So please, don't pay for your credit score.
Here's another huge one, the fear of checking your own credit. When you check your own report through a site like annualcreditreport.com, it's what they call a soft inquiry. It has zero, and I mean zero, impact on your score. A hard inquiry only happens when you actually apply for new credit, like a loan or a new card. So please, check your own reports regularly. So what should you be doing? It's actually pretty simple. First, make every single payment on time, every month. Set up auto pay if you have to. This is the biggest piece of the puzzle. Second, keep your credit card balances low compared to your limits. A really good rule of thumb is to stay below 30% utilization. And third, keep your old accounts open even if you don't use them much. Closing them can actually shorten your credit history, and that can ding your score.
But what happens when you're doing everything right and something is still wrong? Well, errors on credit reports are surprisingly common, and they can be absolutely devastating to your score. But the good news is, you have the power to fix them.
This is so important to get. There's a federal law called the Fair Credit Reporting Act, or FCRA, and it gives you specific legal rights to make sure the information on your report is accurate. You are absolutely not powerless in this process.
Under the FCRA, you have the right to get a copy of your report. You have the right to dispute any information you believe is wrong. And if you do, the credit bureau must investigate your claim and correct or remove anything that can't be verified, and they typically have to do it within 30 days.
So here's your action plan. Step 1. Get your free reports from all 3 bureaus at annualcreditreport.com. Then comb through them, looking for anything that seems off. If you find an error, you can file a dispute directly on each bureau's website. Just remember, you'll probably need to dispute the same error with all 3 bureaus to get it fixed everywhere.
Okay, we have covered the foundation, the habits, and the fixes. Now, it's time to reveal that secret weapon we talked about right at the beginning. That one technique that can cause a massive, short-term jump in your score right when you need it most.
It's called the AZEO method, which stands for all zero except one. And the strategy is pretty much what it sounds like. You pay off all your credit card balances to zero except for one. On that single remaining card, you let a very, very small balance report on its statement. This is how you game the amount owed part of your score to perfection.
Here's exactly how you do it. First, pick one of your major bank cards. Second, and this is important, before that card statement date, pay every single other card you have down to a zero balance. Third, on your chosen card, let a tiny balance, I'm talking just a few dollars, way under 9% of the limit, get reported on the statement. And step 4 is crucial. After that statement is generated, pay off that small balance before the payment due date. This way, you get the full score boost without paying a single penny in interest. It's awesome.
I think this is the best way to think about it. You don't wear a full suit just to hang out at home, right? You wear it for the big job interview. AZEO is your financial suit. You put it on 1 or 2 months before a big application to make the absolute best impression on a lender.
And that's really the key takeaway here. This is a short-term optimization strategy. It is not a long-term lifestyle. If you constantly report zero balances on most of your cards, lenders might actually close them for inactivity, or they might be less likely to give you credit limit increases. So use it when it counts, then go back to your normal, healthy credit habits.
So, now you have the complete playbook, from the fundamentals all the way to the pro-level strategies. The only question left is, when is your next big financial interview? Whether it's a mortgage, a car loan, or just getting the best terms you can, you now know exactly how to make sure your credit score is dressed for success.